Here is a number I want you to sit with for a second. An investor with 3 properties in New South Wales, all held in their personal name, total land value of around $3 million. On paper, they look like they're doing well. Their gross rental income across the portfolio is about $150K a year. But what you do not see is an annual land tax bill of $31,000 a year. That's calculated on roughly $1.9 million of land value sitting above the New South Wales threshold at 1.6%. Gone before a single property expense is being paid, before a single mortgage repayment, and before a single property manager has taken their cut. That takes a gross yield of 3% and quietly knocks it down to 2.4% overnight. And the thing is, most investors do not see it coming until the notice arrives in the mail. Land tax is one of the most consistently overlooked costs in property investment. People model their rental yield, they model their mortgage repayments, they think about maintenance and property management, but they do not model land tax. And for investors with 2, 3 or 4 properties, it can quietly become one of the single largest holding costs in your portfolio. I know this firsthand. I've been an investor for 20 years, building my portfolio to over $30 million, and spent 8 years as a mortgage broker watching clients make this exact mistake. So in this video, I'm going to walk you through exactly how land tax is calculated, where investors make the mistakes that cost them the most, and the strategies that can help you structure things so you're not writing checks you never planned for. And with that said, let's get into it. Let me walk through the mechanics, because most investors only have a vague understanding of how this works, and the vagueness is exactly what gets them into trouble. Land tax is not calculated on the purchase price of your property. It is calculated on the unimproved land value. This is the value of the land itself as assessed by the State Revenue Office, separate from any buildings or improvements on it. And critically, it is calculated on the aggregated land value across all the investment properties you hold in a particular state. Let me show you what that looks like in New South Wales. Say you buy 2 regional properties, each with a land value of around $400,000. Your aggregated land value is $800,000. The New South Wales threshold right now sits at 1.075 million, so you are under it. No land tax. That feels fine. But here's where the compounding nature of property starts to work against you. It is the land that appreciates over time and not the buildings. So as values rise, that $800,000 in land is going to creep upwards, and the threshold is not moving with it. New South Wales actually froze their land tax threshold at that 1.075 million as of January 2025. So the bracket stays still and your land values keep climbing towards it. And if you buy a 3rd property before that happens, you're almost certainly pushing yourself over the threshold immediately. Now the rates vary by state, and the thresholds are very different, which matters enormously depending on where you are buying. In New South Wales, the threshold sits at 1.075 million. In Queensland, it's 600k. South Australia, 833, and WA is 300k. Tasmania is 125k. And then there is Victoria, where the threshold is only 50k. The ACT has no threshold at all, so every dollar of investment land value is assessed. The Northern Territory has no land tax at all. What that means practically is that if you are buying investment property in Victoria or the ACT, you're walking straight into a land tax liability from day one. There is no runway, there's no grace period. Whereas in New South Wales or Queensland, the thresholds give you more room to build before it starts biting. And one more thing that catches people off guard. Each state only counts the properties you hold in that state. So a property in New South Wales and a property in Victoria are assessed separately by their respective state revenue officers against their respective thresholds. That distinction becomes important when we talk about strategy. There is one more mechanic worth understanding before we move on, and that is the assessment date. Land tax is assessed on a specific date in each year. In New South Wales and Victoria, that date is the 31st of December. In South Australia, WA and Queensland, it's the 30th of June. What that means is that if you settle on a property on the 2nd of January in New South Wales, you will not be hit with land tax until the following year's assessment. If you settle on the 30th of December, you'll be assessed as the owner on the 31st, and you'll have to pay land tax for that full year, even though you only own the property for a single day. The saving on a typical property is not enormous, but it is real, and if it costs you nothing to be aware of it when you're planning settlement dates. If your settlement date is unavoidably close to an assessment date, talk to your conveyancer about including a land tax adjustment clause in the contract so that the liability is apportioned appropriately between the buyer and seller. Now let me talk about where investors consistently make mistakes, because this is where the real cost sits. The most common situation I see is an investor who's bought 2, 3, or even 4 properties all in their own personal name. all in the same state because it was simpler. No trust structure, no spouse strategy, no cross-state diversification, just one person, multiple properties, all aggregated together against the one threshold. That structure made sense at the time, but as the portfolio grew, as the land values increased, the land tax exposure grew with it. And by the time the bill arrives and is 20 or 30k in a year, that investor is faced with a genuinely uncomfortable choice. Leave it as is and keep paying, or restructure, which means transferring ownership between entities, and that triggers both stamp duty and potentially a CGT tax event. Neither option is cheap. The honest answer on restructuring is that it depends on the numbers. You would need to weigh up the cost of stamp duty and CGT against the annual land tax savings that you project forward over the years that you plan to hold the property. In some cases, the transfer cost is worth it. In others, the break-even point is just too far away to justify it. But here's the thing, that calculation exists at all only because the structure was not thought through before the first purchase. The best way to avoid an expensive fix is to get the structure right from the start, before you have a land tax problem, not after you already have one. If you are sitting on 2 or 3 properties and you're not sure whether your land tax exposure sits, click on the link in the description and book a call with our team. We will map out your current position and show you exactly what the next purchase does to your land tax bill, depending on how it is structured. Now that you understand how the problem compounds, let me walk you through how to think about minimizing it. The core principle is straightforward, even if the execution requires planning. Each individual and each entity get their own land tax threshold. So the goal is to spread your portfolio across multiple thresholds rather than stacking everything up against one. At the most practical level, that means thinking about the strategic picture before you buy, not after. If you're a couple building a portfolio together, you each have borrowing capacity and you each have a land tax threshold. The way to make both work together is to plan out from the beginning whose name each property goes in and which state. A simple example, 2 people on strong incomes building a portfolio together. One person buys an investment in New South Wales, and then one in Queensland, and then one in Victoria. The other person does the same across the same 3 states. Now you have 6 properties spread across 6 separate threshold positions across 2 completely different individuals. The land tax exposure is fundamentally different to the same 6 properties all sitting in one name in one state. The order of those purchases matters too, because it depends on whose borrowing capacity is being used at which point. That is the conversation to have with your broker before you buy, not after. Beyond the spouse strategy, different entities can also be used to provide access to separate thresholds. Company structures, trust structures, each has their own threshold position. But I want to be really clear here. I'm not recommending any structure and I'm not giving tax advice. This needs to be worked through carefully with your accountant because there are other tax implications that sit around entity structures beyond just the view on land tax. And from a lending perspective, it also needs to be factored into your borrowing capacity planning because trust and company lending works differently to personal name lending. You'll need to make sure that the structure supports your ability to keep borrowing, not just minimizing land tax in isolation. What I will say is this. The combination of state diversification and ownership diversification is the most practical toolkit available to most investors. And the time to apply for it is when you're out planning the next purchase, not when the bill arrives. Land tax is one of the most consistently forgotten pieces in the puzzle of investment planning. And it's not because investors don't care about it, it's because most brokers do not bring it into the conversation. When a client comes to me with 2 or 3 properties and they are planning their next purchase, one of the first questions I ask is where does that land tax threshold sit right now? Because the structure of that next purchase, whose name it goes in, which state it's in, what entity holds it, can mean a difference of $10,000 for every single year for the life of that portfolio. Over 20 years of holding, that is a material difference in your net position at retirement. If you are not having that conversation before you buy, you're setting yourself up for exposure that becomes expensive to fix and expensive to carry. Most brokers will help you get the loan approved. The conversation I want to have is whether that structure of the loan and that purchase is going to quietly cost you for the next 2 decades. Let me leave you with something concrete. If you already own investment properties, pull out your latest land tax assessment notice and find the assessed land value for each property. Add them up. That's your current aggregated land value in that state. Then look up your current threshold for your state. I'll link the relevant state revenue office pages in the description, and you can work out how close you are to the limit. If you are within range of pushing over with your next purchase, that conversation needs to happen now, not after you've signed the next contract. If you are a newer investor who has not yet hit the threshold, the most valuable thing you can take away from this video is that planning the structure before you buy is infinitely cheaper than restructuring after. Talk to your broker about what the next purchase does to your land tax position, depending on how it is held. If they cannot answer that question specifically, then that is useful information. And whether you are at 2 properties or 4, the question to keep asking is this: am I building a portfolio or am I building a land tax liability? Because with the right structure, you can do the former without the latter. If you want to map out where your portfolio sits on land tax right now and what your options look like before your next purchase, there is a link in the description where you can book a call with our team. It is a proper conversation about your actual numbers, not a generic overview. And as always, brokers are paid by the lender, so there's no cost to you.